You're back. Great. Today we're going to start by talking about exactly what is a futures contract. Now, the example they give you in the short courses at cmegroup.com, and also there's lots of stuff on YouTube. The example you always hear is the example of the jeweler who has a contract to make like Olympic medals out of gold and silver in like 6 months. He doesn't need to buy the silver for like 3 months, but he wants to lock in his price now so he can make a good cost estimate. So, for example, let's say in January, he buys a futures contract to buy silver in May. He buys a May contract for a contract of silver, and that way his price is locked in. He puts up like 20% of the money, then it actually, I think the Comex rule now is 18,000 initial margin to buy a silver contract, and he comes to the rest of the money in May. Now, some people call that hedging. I prefer to use the term locks in the price. Okay, so let me give you an example that happened to me. So you can see here that on February 19th, I bought a March 21, that's March delivery month, year 2021, and the price was $27.25. That was the spot price at the time. So the nominal price, the overall price of the contract would ultimately be 5,000 times 27.25. So I'm agreeing now, or in February 19th, I'm agreeing that I'm going to pay upon delivery the full 5,000 times 27.25 in February. Now that could be for the good or for the bad, because oftentimes you go to the store, the coin shop, and you pay your money, you get your coins, and your price is set. But in this case, you've locked in your price so that when you ultimately pay all the money to get your silver, you may be paying more of that or less than that. So if the price goes up, you've done good. You made money because you think you're getting a bargain, but the price goes down, you're not feeling so good about it. And I didn't feel very good about it for a long time, because those of you who watched the price of silver from February and March and all the spoofing going on, I think it got down to like $24. I was down like $3, and when you're talking 5,000 ounces, $3 is $15,000. So you can feel really bad about it. There's a real difference between owning the silver and the price going down, because you have the silver and the transaction is complete and you have to live with it. But when you have a statement saying that you've paid $27.25 and the price is now $24.25, and you have a paper loss, and you can't get out of it. It's like you have to follow through on this transaction because you agreed, like I agreed in February 19th, to pay $27.25 an ounce, even though the price might be below that. Now, ultimately it worked out good, because now, at least as I'm recording this, silver is like about 28, so I'm feeling a lot better. But psychologically, it's kind of a bummer. So let's talk about some of the particulars of the Comex silver contract. And for that, we will go to cmegroup.com. And this is a page from there that you can look at. And the first thing we see is that the silver contract for the Comex is 5,000 troy ounces. So like I said, I paid $27.25, and the nominal price was 5,000 times that. That's the price of the entire contract. There is on the Comex a 1,000 ounce silver contract. I don't exactly know the name of it, but it's all I know is that you can't take delivery on it. If you do purchase it and quote take delivery, you get a certificate, and you can accumulate 5 certificates for a total of 5,000 ounces, and then put them together and then take delivery on the 5,000 ounce contract. How that's done, I don't know. Who wants to bother with it? I don't know. That's what the rules say you can do. But if you're looking to take delivery, you need to go for the 5,000 ounce contract at least at some point. Okay, there are 6, I guess you call them trading months or delivery months for silver contracts, and they are January, March, May, July, September, and December. There's 6 of them, and if you look right here, you'll see that January, March, May, and September are traded out for 3 months, which means you can buy a future within 3 months of that. You're buying only 3 months in the future. And they have special rules for July and December where you can go out up to 2 years. So if you want to like lock in your price for like 2 years, you can do it with those 2 months. That's your July and December. So what I did was I just bought the nearest month, and I just said, well, I want to buy it as soon as possible. I would rather just go into the Comex and say, give me a contract, here's my money, and not have to do all this future stuff and wait around for it. And you know something? There may be a way to do that. I just don't know what it is. If somebody knows how that's done, send me a video or a recording, and I'll put it on, or just send me a letter, I'll speak it for myself. Because like when PSLV gets all this money, gets like $10 million, and he's going to go in and buy some more silver. He's not doing a future. He's going someplace and giving them the money and getting the silver. I heard the term spot purchase one time on a newsletter I get, and I don't know what that means. I actually wrote a letter or an email to my broker and said, do you know what this is, a spot purchase? Does that mean I can just give you the money, like maybe during delivery month or else otherwise, and take my delivery right away? And he didn't answer that. I guess only certain people know about that stuff. So what I'm talking about now is the futures method of doing it, and there may be other ways to do it. Like I said, I don't know everything. I can only tell you what I've done. Okay. Now, if you're studying this stuff, and like on YouTube especially, you'll often see these letters associated with the months. Like there's March would be associated with the letter H for some strange reason, and May would be K, and all the other months have these designated letters. But that's kind of an old system. Although you see YouTube videos where they talk about it, in reality, like on TD Ameritrade and the other places you look for futures prices, they don't use those letters anymore. So don't worry about that. You'll see May 21 for the May contract, or March 21. Or let's say you're going out a year, like December 22, that would be DEC 22, and that would be the futures contract for December 2022. So don't worry about that. Okay, I hope you're excited now. We're up to the point where you've all been waiting. We're going to make our first trade, and this is going to be the shortest section I've ever had. If you are on a computer system with your broker where you enter the orders yourself, I can't help you there because they're all different, and that's not the way I did it. I just call up the guy. Now, we're talking about full service brokers. I got the phone number, and when the phone rings, somebody picks it up. I'm talking to a broker, a guy who can place the order and answer whatever questions he can answer. I always kind of bummed out because he couldn't answer all the questions I had, but I said, okay, guy, I want to buy a March 21 silver contract. And he said, well, you want to buy it in market or you want to put a limit on it? And, market just means whatever goes according to bid and ask at that time. Limit means you can maybe say you don't want to pay more than this. You could make it right where the market is or a couple of cents below. I was so cheap, I want a couple of cents below, but I did execute. So you just tell them you want what you want. You want a March 21 or December 22 contract of silver, and you want to buy at market, or if you want to put a little limit on it, you placed your order. And we'll talk about the money in a few minutes, how much you have to put up then and later. And there's only one other major question you have to answer at that point is, do you want to put a stop loss on it? Okay, so let's say I bought a 27.25, but I was afraid something would come along and knock the price down to, 15, and I didn't want to lose. That'd be like a lot. It might be like $12,000 if you knock down that far. So you can put a stop loss on it, and that would mean it's like a pending order to sell the stock when it gets to a certain low point. There's good and bad reasons to do that. I didn't do it this first time. I did it a later time. We'll talk about that later. But you're placing your order, stating your month, and whether you want to limit it or not, or whether you want to stop loss or not. And that's placing your order, and then you place your first order, and that's it. Now that you have your contract in place, what do you need to do? Well, the next relevant date would be, I think it's the third to last business day of the month. It's settlement day. I would just say do everything ahead of time, because like I'm not really good at remembering things on the exact right day, so I do things like ahead of time to make sure I'm in compliance. So I think settlement day is the third business day before the end of the month, but I would say do something like a week before. You have three choices leading into your delivery month. The first is you could just sell your contract. You could short out your long position, and either you have to put up money. If you took a loss, and if you took a gain, you get money back. The second thing is you could, quote, roll into the next delivery month. Here's a statement where they did it to me by mistake. They corrected it, though, but you can see that it's actually two transactions. You're selling your current month, the upcoming delivery month, and then you're buying back a long position for the following month. So you can see what they did to me was, here's a May sale and a July buy, and that is a roll. And you'll notice that you pay two sets of transaction fees. So it's like 31 to sell the March and 31 to buy the July. Okay? Excuse me, now, to sell the May and then buy the July, according to this statement right here. And or your third choice is to stand for delivery. And I'm not sure if that's automatic or not if you don't do either of the other two things, but I would just recommend contacting your broker in writing and tell them you want to stand for delivery and when do I have to put up the money. It'd be nice if you got an answer which kind of proves they received it. I had that, so they couldn't get out of that mistake they made on the roll they did for me without my acknowledgement. But anyway, your three choices are sell, cash settle with your loss or your gain, a roll, which is a sale and a buy of the next upcoming delivery month, or to stand for delivery. And we're talking about standing for delivery. So make sure you do that before the settlement day. So I'd just say contact your broker in writing, like a week before the end of the month, knowing that's what you want to do. Okay, so what we're going to go from here is we're now going to talk about when you put up your money and for both initiating the contract and for taking delivery. And it's not that complicated. But once you understand it's not that complicated, but when you initially place your order, you have to have money on account with the broker. And the amount you have to put up is called margin. The amount of margin for certain contracts, I believe, is regulated by the Comex. So the current rule, look at my statement right here. I think it's, you have to put up $18,000 initial margin to buy a silver contract. So you have to have $18,000 on account with your broker to enter into the futures contract. Now, the way that my brokerage firm dealt with it is there are two ways to get them money. The first is you can wire them the money, which I did initially to make sure I could get my trade in, which was really stupid of me because it was a bad time to buy because everything went down right after that, but be that as it may. The other way is they want you to set up an ACH, which is a way that they can draw money out of your designated bank account. So you have to give them permission to draw money out of a certain bank account, and that's where you put your money. That's a lot faster. Think about, wiring money is, at least my bank, the fee for wiring was like $20. So with ACH, which is the, where they draw the money out of your account, there's no additional fee. Other than they don't charge a fee for that. So that's good in that way, but it also gives them the right to pull the money out of your account. And that's why when I talked earlier about the spoofing and are you dealing with somebody you really know that you can trust, you're giving these people permission to take a lot of money, like over $100,000 at some point. So that's why I emphasize making sure you're not being spoofed, and why you should be very careful about who you're initially setting things up for. Remember Bernie Madoff? What he did is he just made up these statements and sent them to people, giving the impression that they really had investments, and nobody really checked it out. So be careful. You'd hate to lose your money that way. Okay, so you are going to make your first trade. You put your, look what it's $18,100 with your broker. You really better put a little bit more than that because you have some expenses to cover. So I just say send them $20,000 on your account, and then they place the order, which they can do because you place the order, you have the margin there, and then you don't have to worry about putting more money until you want to take delivery. Now, I can't tell you the rules for this. I can tell you just exactly what my broker told me. Because I'm not exactly set on the rules, what I would do is I called them or sent them an email and said, okay, I want to take delivery. When do I have to put up the money? And his explanation was, okay, we have you down for delivery. Your margin's there. You don't have to put up any more money until you're matched for delivery with the seller. You're the long position because you're buying. The person selling, which is like the producer or who's ever selling the silver, that's the short. So when the shorts and longs are matched, you're consummating the contract. And it's at that point you have to put up the money. So you're going to get notice from your broker when you have to put the rest of the money. And the money would be the contract price less whatever you've put up before, like your initial margin, which is like 18,000 plus any margin call. So I put up another 5, so that's 23. So basically on a $135,000 contract, when I put up 5 plus 18, that's 23. So 135 minus 23 is 112, and that's what they'd pull out. That's what you have to make sure they have. You don't have to do until you're matched. Now I'll tell you what happened to me is I got matched kind of late in the month. Now I don't know if it's because I'm a single contract when there are other people doing tens and hundreds of contracts, but I got matched about the 15th to the 16th of the month, and that is when I had to put up my money. But even though you have this sort of kind of credit working there, well, you don't have to put up all the money at first. I just assume you have all that money ready to put up when you enter into your contract. Unless you're going way far out, we're not playing a spec game here. We're buying silver for physical delivery, and you better have that money ready to go. You don't have to put it up right away, but you better be ready to put it up when you are matched, because then you have only a couple of days to do it. And you know when it's going to, so don't have to do something to get the money, have the money ready to go. One more interesting thing about margin that I wasn't so clear on, I asked the question, is that, you're controlling, like, let's say a $135,000 contract with only $18,000. And in some ways, you think, well, they've kind of lent me that money, but it's not a loan. And there's no interest on that $100,000. So you're controlling a $135,000 contract with $18,000 and not paying interest on that 100 and whatever it is above that, like 117,000. You're not paying interest. You're controlling that contract without paying interest on that money because it's not a loan. It's just sort of like it's your margin. It is your securing of the contract, like a deposit, but there's no interest on it. I thought that was kind of interesting. Goodness, we've gone over 20 minutes now, so time is up. Next time we're going to start with a little more explanation of the margin rules, and then I'm going to give you a recap of everything up to this point. Setting up your account, getting your money there, and placing your first order, and then how you actually get to the point where you're going to take delivery. And from there, we'll get to what actually ended up being the hardest part for me. So that'll be in a couple of days. Thank you, and see you later.